Deal execution and book building, the Warren Fox Group. Course breakdown. Class 1, collecting term sheets, and Class 2, closing deals and managing relationships. Collecting term sheets. Class breakdown. During this class, the Warren Fox Group will cover the below topics: collecting market interest, majority sale auction process, minority sale book building, and additional comments on capital raising. This is lesson 1 of class 1. In this lesson, we will provide a high-level overview of different deal types in the capital markets and the processes, procedures, and participants associated with each deal type. Background. The capital markets are large and complex, servicing a global consortium of buyers and sellers on a 24/7 basis. The market offers its participants a wide array of solutions from both the buyers and the sellers' perspectives. Investment bankers are simply capital markets advisors, and the goal of an investment banker is to help the client successfully navigate the capital markets as outlined in the engagement letter. Depending on the bank and the investment banker's position, the practitioner can either be exposed to a very narrow or a very wide set of client engagements. Each engagement is different, with its own processes, procedures, and objectives. In this class, the Warren Fox Group aims to describe practitioner responsibilities nearing the end of an engagement. In prior classes, similar terms have been utilized interchangeably. Therefore, to best align ourselves, let's begin with clearly defining terms. Terminology. Let's review terminology that deals with the common types of advisory, the common deal types, and the participant interactions within each deal type. Common types of advisory. There are two broad methodologies of investment banking advisory: buy side, advising clients on the purchase of an asset; sell side, advising clients on the sale of an asset. For the remainder of this course, let's focus on sell side advisory. Common sell side deal types. There are two main sell side deal types: majority sale, otherwise known as mergers and acquisitions process, and minority sale, otherwise known as a capital raise process. We recognize that not all majority sales are M&A deals. Some could be majority recaps. For the purposes of this course, let's assume majority sales are M&A deals. Interactions in M&A deals. Market participants interested in acquiring the target business in a majority sale are known as buyers. In a majority sale, there is typically one buyer, and the process is sometimes referred to as an auction process. Practitioners try to elicit competing buying pressure from multiple buyers who desire the same asset. Potential buyers submit bids, or IOIs, to illustrate desire in buying the target business. The seller reviews each bid submission with its board and its bankers and moves forward with the most attractive bids. The seller will eventually narrow its choice down to a single buyer. Interactions and capital raises. Market participants interested in making an investment in the target business in a minority sale are known as investors. In a minority sale or capital raise process, there can be multiple investors that participate in a single transaction. In many cases, a lead investor will submit terms and pricing to the target business, and then the other investors will participate to fill out the round. The process of collecting interest from a variety of investors is known as book building. Conclusion. In the remaining lessons of this class, the Warren Fox Group will cover the documents and procedures involved in each process: majority sale auction process and minority sale book building. Thank you for tuning into this lesson. We look forward to seeing you at our next lesson, in which we will cover majority sale auction processes.